The stock market has just opened today and we can see nearly red right across the board, but it'll be interesting to see how it closes out for the week. But our attention today is going to be on Airbnb. Now, they reported their earnings after the market closed on Tuesday, and we can see they are now trading at their 52-week low, and in fact over the last 12 months they are down around 18%. So when we take a look at their earnings to understand what are the issues that this company is facing, well, the headline does read that the company dropped 14% on slowing US demand, and they've said they expect moderation in their year-over-year growth in their key nights and experience category, so not something that investors want to see. Another caution that they have discussed is that they are seeing shorter booking lead times globally, and therefore they believe there is a slowing demand from the US guests, which will ultimately affect their top line revenue as well as the profitability. They have, however, said that users did book their second highest quarter results, 125 million nights as well as experiences. Now, when we dive into the actual numbers to see how strong they were, what we notice here is 86 cents, the EPS. Unfortunately, the market was anticipating 92 cents, so a miss on that metric. And on the revenue, a marginal beat, 2.75 billion versus the 2.74 that the market was anticipating. Now, on the same quarter from last year, revenue is up double digits, 11%. However, their net income does sit lower, 555 million, whereas the same quarter last year, they did see 650. Not a great sign, and as we have discussed before, we are seeing a weakening in the consumer environment, not just something noted from Airbnb, but for example, when we did look at McDonald's that reported their earnings, they also talked about a weakening of the consumer, and in fact, they had their same-store sales fall for the first time since 2020, and we have seen this right across the market, including Starbucks as well as Hershey's. Now, let's just quickly go through this company again. At a high level, it is down around 18% over the last year, and we only get one buy rating from Seeking Alpha, a hold from Wall Street, and a hold from Quant. And we do notice the forward P sits around 27. So let's find out in today's episode if this is a strong undervalued buy right at its 52-week low. Now, first thing we want to look at are the underlying metrics. We're going to start off with the free cash flow. As always, we want to see growth over the longer term, consistent as well. Now, we get that for the large part. Bear in mind COVID, so it was justified the drop in 2020, rebounded very sharply. 2023 at 610, do bear in mind, over the next 12 months, it is anticipated to be fairly flat. Then we move on to the growth in terms of a percentage format. Now, double digit every single year, again, negative 30% in the COVID period. And for the more recent quarter, as we discussed, 11%. So you have to understand and ask yourself, do you believe that the growth story that we have seen with Airbnb is starting to slow down, as that will ultimately affect the valuation, which we will come on to. In terms of numericals, well, from 2017, their top line has pretty much quadrupled, 2.5 billion to just under 10. And something that we have to point out, not something we like to see from companies, but they would have diluted your position over the longer term if you were a shareholder in 2017. We do, however, note from 2022, they do look to be buying back some shares, although fairly small, and something that we will discuss if we do see it continue. We then move on to the ROIC. Now, we will point this out when we do an in-depth look at the income statement, but ultimately they haven't turned a profit for a few years, and we can see in 2021 where they did turn profit, 8% on the metric. Remember, very important, we want to see a minimum ideally of 10% or more. Give us faith, management are able to effectively allocate their capital. Last 2 years looking healthy, as well as the 16% on a trailing 12-month basis. We then move on to the operating margin. Again, no surprises. As we said, they didn't turn a profit for quite some time. 9% in 2021, 15% in 2023. Ideally, 16% is where we want to see, so not too far off it over the last few years. Again, consistency is something we truly value on this channel. Free cash flow margin looking very strong over the last few years. 5% at a bare minimum. If we can keep this up moving forwards, looking very good, and maybe in the future we can call this a very nice free cash flow machine. Net debt to EBITDA, remember, earnings before the interest, tax, depreciation, amortization. These are the number of years it would take the company to pay off all of their debt net of cash on hand. Wouldn't even take them one day over the last 3 years. Wouldn't even take them one day over the next 12 months. So very strong balance sheet. Now before we continue, just to let you know, we have released our latest free weekly article. If you want access to this or any others, you can grab a copy by clicking on the pinned comment below. And we've also released our undervalued 35 stocks for the month of August, and we've also denoted the ones that are within our own portfolio, so do go ahead and grab that. One thing we also like to look at on this channel, insider institutional movement. We'll start off with the insider sitting at just under 28%, pretty high for ones that we have seen previously on this channel. 474 million worth of sales by these insiders over the last year, with no insider buying noted. Now, one thing that we have to point out is that even though Q3 we do see a large chunk of sales at 47 million, this is something that is very consistent on a quarter-by-quarter basis, so no surprises, something that we shouldn't truly be shocked by. And for those that just want the transparency of who these insiders are, well, we can see the Chief Technical Officer has been on a bit of a selling spree, as well as the CEO. In fact, the 6th of August, so just a few days ago, he did sell around 600 shares, netting him 75,000, with some of the more bulkier buys coming on the 22nd of July by both the CTO as well as the CEO. As always, we don't believe this is a bearish signal, but we do just want to include it as well. Ultimately, they will sell for personal and financial reasons. We then move on to institutional ownership, sitting at just under 81%, around 7 billion worth of sales over the last year, and around 8 billion worth of buys, so marginally more buys than sells, but we do note a larger buy in the more recent period in Q2. The same to be said for Q1, although we see the opposite in Q4. So ultimately, while institutions are buying a little bit more than they are selling, do always do your own due diligence. Never copy insiders or institutions when you are making any purchases. So let's take a look at the income statement. Now, we've already gone through the top line revenue. We want to understand, does the bottom line net income tell us a similar story? As we said, just over the last 7 years, we have seen pretty much 4 times growth to the top line, moving in the right direction as well that we want to see. Granted, we have to say that COVID year was expected. So what does the bottom line net income tell us? Well, we did mention they haven't turned a profit for quite some years. In fact, it started in 2022, and since then the growth has been very strong. But as always, on this channel, we want to see that consistency, something we will be keeping an eye on moving forwards. We then move on to the health of the company, total cash versus total debt. Net debt to EBITDA was 0, so we expect this to be fairly strong and healthy. 3.3 billion worth of cash short-term investments in 2018, 11.3 billion in the latest quarterly report, so nearly 4 times growth, and has been moving in a similar direction to the top line revenue. So how does the total debt compare? Well, what we do note here, in fact, is that they had no debt in 2018 and around 2.3 billion in the latest quarterly report. So as we can see, very inconsistent year on year, and the cash is far more superior than the total debt, so a healthy balance sheet. We then move on to the earnings. Now, we like to see historically how they've performed as well as future expectations. Now, as we just mentioned, they missed that more recent Q2 performance, and over the last 4 quarters, a bit of a hit and miss, 50% track record. Moving forwards, the next quarter, they're anticipating a massive drop, 67% on the year-on-year analysis. But ultimately, they do see growth moving forwards, and if they hit that December 2025 EPS estimate, the forward PE will come down to just under 25. The next stop is at the valuation underlying metrics. We get a D+. Now, when we take a look at this on a P non-GAAP basis of 27, that is much higher than the sector median of 15. In fact, you are paying a 79% premium, but as always, there could be reasons that justify why it deserves that. But regardless, whichever valuation method you use, we can see Airbnb does trade at a lofty premium. Then we take a look at the growth grade and the underlying metrics that support this, and they get a C. So let's understand a few things. Year-on-year growth, we see 15.6%. 2% is the sector median, so ultimately a lot stronger. Revenue growth moving forwards, whilst it does slow down, still very strong at 13 versus the sector at 3.6. And the main thing we like to draw your attention to is the earnings per share. Over the next 3 to 5 years, around 15% growth with the sector median at 10. So ultimately, we probably would give a much better grade than the C, but this is the information if you want to incorporate it into your analysis. We then get to the profitability, A+, absolutely phenomenal gross margins, 83%, sector at 37%, Bottom line, very, very strong, 46%. That is incredible when the sector median sits at 4.68 and cash from operations 4.4 billion versus the sector median of 273. You could argue no surprises there with this amount of cash, especially for those that do use the app for the amount that they do charge as their own fee and the cleaning fee that comes with it. So how does their performance compare against others in this well-known industry? We have Marriott International, Hilton, Royal Caribbean, Booking Holdings, the majority of these which we have covered already on the channel. So over the last year, total return, Airbnb the worst performing, down negative 19%. For argument's sake, for those that want to compare it to Booking in the same period, it is up around 7%. When we expand this over the last 5 years, Airbnb not too far off those in the industry, around 67%, Booking marginally higher at 79%, and when we zoom out over the last 10 years, what we can in fact see is, whilst we only have the information from around 2020 at negative 18%, we can see Booking, as well as the majority of others, have performed very strongly. So just something to bear in mind. Whether or not you find that useful, do understand that past performance is not an indicator of future performance. Now, as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Intrinsic value, then we get to $158. How we got to this price? Well, we put it through the DCF model. As you can see, free cash flow year on year. Average growth rate, it is negative to a large degree, given it has skewed from negative to positive over a few years. And what we've done is we've gone for a growth rate of 6% moving forwards, and we have a low, medium, and high 468. Again, very subjective, and as always, you can grab a copy by clicking on the pinned comment below, running through your own numbers, whether or not it's for Airbnb or any other companies. So at a 6% level with the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and we get to an intrinsic value of 158, indicating 38% upside. Now, a lot of people will say that is way too optimistic, so at 4%, again for transparency, we'll show you it does come to a price of $139, as we can see here, still indicating 21 upside. We then move to 8% for those that are a lot more optimistic, and we can see $180, around 57%. Again, if you do grab a copy of the model, for example, you can put in 10% if you believe that is more appropriate, and this shows that this company is half the price of its intrinsic value or thereabouts. But ultimately, we're going to take through the 6% to the final slide, and we can see here we always like to add a margin of safety. 10% is what we input and execute if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, if you believe that it is a buy up to $142, then we keep going till it's near the current trading price. And what we can see ultimately in today's episode, it isn't at a 30% MOS level yet. You'd have to wait for around 110. But right now you are getting at least a 25% MOS, with Wall Street giving this a $145 price target over the next year with upside of 26%. As always though, do let us know your thoughts below. Is this one that at its 52-week low you do believe is a great time to enter? Maybe you believe with the weakening of the consumer environment that it is better to wait a few months or a few quarters and then buy it at a cheaper price. As always, let us know your thoughts. If you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and click on the pinned comment below where you can sign up to the free weekly newsletter and join us on the Patreon where we can talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.